Hi everyone, in this video I want to talk about the role of a central bank and the prudential regulation system. Now, it's rather important to remember that country by country the central banks have different remits and different ways of working, and the prudential regulatory remit is spread quite differently. But in terms of a general summary, I think we can say that central banks arise and exist for largely two reasons. Firstly, they are key institutions in the macroeconomy. They primarily exist out of the necessity to control money supply with wider goals around facilitating saving and to channel into investments and to maintain price stability, support growth in the economy, and to support low and consistently stable levels of unemployment. The second reason we find that we have central banks is largely out of historical necessity, and some of the oldest central banks, such as that in the UK and in Sweden, exist for reasons that do not make so much sense today. The oldest central banks come in their role as banker to the crown or banker to the government, and that's largely how the UK Bank of England started, as the banker to the government in order to raise money and finance conflicts with France. More modern central banks, such as perhaps the Federal Reserve, founded in 1913 in the US, exist to try and centralize control of the money supply and build in the ability for some rate setting activity to try and gain some broader control and a wider macroeconomic policy toolkit. Now, in the present times, the key function of the central bank is to issue currency and control the money supply. This right or ability gives the central bank the ability to manipulate interest rates as a result. They can control the scarcity of liquid money by putting money in and out of the economy through what's known as open market operations. It's not the case that they just photocopy £10 notes. What they actually do is buy and sell government bonds into and out of the markets. So it's not actually changing the amount of money in existence, it's changing the amount of liquidity in a particular marketplace. And by controlling the money supply, the central bank has its own balance sheet. And on a central bank balance sheet, money in circulation is not an asset, it's a liability. What the central bank must do is hold assets equivalent to those liabilities. So it's certainly not the case in the present day that a central bank will be saying, $1 is worth 35 ounces of gold. It's not this at all, but there are still assets which back up the fiat currencies which we are now using. There are few functions of the central bank, mostly around supervision to ensure stability of banks, and that banks, or shall we say panel banks to be more precise, are maintaining adequate liquidity to continue their day-to-day operations. One bank becoming illiquid is a minor issue. One bank becoming insolvent is a much more major issue. Several banks becoming insolvent is a macro-prudential crisis, and something then has really, really gone wrong. Now, the age-old million-dollar question is, should banks or panel banks be allowed to regulate themselves? And experience largely tells us the answer to that is no, it's not a good idea. What we instead do is pose what's perhaps known as a moral hazard problem and allows central banks to provide support to panel banks, but also regulate panel banks. Now, let's start with what that support looks like. On a daily basis, central banks will offer panel banks access to a facility called repo. It's a repurchase agreement. So if a panel bank has a end of day liquidity shortage, they're able to borrow money on a very short term basis, liquid money, perhaps overnight, from the central bank. It's usually at a very high interest rate. It's very much the last resort. However, this is possible, and this is one way that a central bank may support a panel bank to remain liquid. The idea being that any bank which is consistently liquid is, by virtue, consistently solvent. Now, we turn to the regulation side. Now, panel banks can be regulated in a host of ways, and in the United Kingdom, what we've talked about before is perhaps that the regulation has two flavours. We have conduct regulation and prudential regulation. Conduct regulation sits with the Financial Conduct Authority. This is the rules of the system, consumer protection, and covers the behaviour and ethical standards around individuals. What we're perhaps more interested in from a central bank perspective, though, is prudential regulation. Now, when we start looking at prudential regulation, we're looking at liquidity and stability. And this is perhaps enforced by the Prudential Regulatory Authority, but the bulk of the standards that a bank is trying to follow on the daily is derived from the Bank of International Settlements and the Basel Accords. And we're presently up to the third iteration of the Basel Accords. They change periodically, mostly as a result of lessons learnt from previous crises or states of disaster. And the present top line standard is the 8% capital coverage requirement laid down in the Basel III standards. So for every pound of risk-weighted capital that a panel bank has loaned out, at minimum they must hold 8% of that value in capital on their balance sheet, and that capital is cash or a cash equivalent. This, by and large, has to be set down in rules and has to be supervised because no panel bank of its own free will particularly wishes to hold large amounts of cash or cash equivalents. They don't earn money, but they are required as a liquidity buffer. They are, shall we say, very necessary. So this is the top line standard. 4% of that has to be in what's known as Tier 1 capital, which is the closest to cash, and remaining 4% is in a slightly more liquid Tier 2 band of capital. This, by and large, is the top line standard. There are much more items in the Basel Accords. They are 3 stabilities around capital adequacy, correct risk management, and transparency built into the Basel Accords. And as I say, they very much evolve and change as a product of financial crisis. So the 2007-2008 Euro-Atlantic crisis starts as a real failure in supervision in the United States, where the Federal Reserve probably didn't call out very high levels of subprime lending and unsecured lending, and the Basel standards at the time didn't really penalise securitization of assets, and it created a system where commodities were flowing around the financial system and overnight they become worthless. And this causes a massive issue and requires large amounts of lender of last resort action on the part of the central bank and funding from treasuries around the world to try and stabilise the banking system and at least maintain some semblance of trust in the banking system, because the second you lose trust in the banking system, people are just going to stuff the money under the mattress again. What was learned here was that capital requirements did need to be a little bit higher. So post crisis, it's increased from 6 to 8%. Systemically important banks have an additional capital buffer added to them. There are no British systemically important significant banks, but others in the US and Japan did have additional requirements to hold extra capital added to them as a result. And also, it's now the case that a lot of the risk weightings change. You now add 100 for anything which is subprime. For a securitized asset, the risk weighting is now 1,250%, which is massive. And that adds a real penalty in the regulations for engaging in the securitization process. It, in essence, doesn't ban panel banks from holding securities assets. It just means the incentive to do it is long gone because the capital requirement is high, high, high. There are some few additional things that are quite hot topics at the moment. The first is currency unions and integration. If you want a good example of a currency union, look no further than the Eurozone or European Monetary Union to give it its proper name. Here you have 20 countries with one common currency, which means you have 20 national central banks, but you have a common money supply, a common monetary policy, and this is laid out by the European Central Bank. So there is a clear scheme of delegation here. If you want another example, look at Central African or West African CAF franc. It's a little bit different, but the bare bones are the same. What's becoming quite interesting now is the role of alternative payment systems and the rise of central bank digital currencies. You can't call them cryptocurrencies, call them CBDCs. In a central bank digital currency, the aim is to achieve a stable crypto asset that has the same properties as money. That makes them not so crypto because they will have to have a centralized counterparty, which in many cases will be the central bank. The aim here is to create a digitized version of the national currencies, and in London it's a digital pound, and to create a parallel to the existing pound, not to replace, at least not yet, but to create a parallel. This is very much central banking territory because it revolves around the control of money supply. And I know in class we've talked about the independence of central banks. And in the UK case, having a highly independent central bank is perhaps very good for trust. That said, there could well be others involved in getting this off the ground. In some countries, particularly developing countries, the move is not towards CBDCs, it's to allowing more mobile money payments. And Ghana is a fantastic example of this. Also, if you want a different example, look at M-Pesa in Kenya. These are both CBDCs and mobile money raise a few concerns around anonymity and money laundering, but there are ways around this, particularly with rules around proof of beneficial ownership, proof of address certainly helps, and the ability to prevent anonymous money moving on banking rails and moving through a CBDC system, which it has a trusted centralized counterparty. So there are considerations and things to think about.